Hello, everyone. Welcome to the eighth lecture of Management 202. So in this lecture, we're going to start talking about the last and maybe the most important topic of corporate finance, right, which is about capital structure, right? And the definition of capital structure is very simple, right? It simply means, the balance of debt and equity financing, right? So, but there are a lot of sciences behind it, and actually, we're going to introduce one of the most important theory in corporate finance, which is, the Modigliani and Miller theory. That's what this MMM stands for, right? And in this theory, like any models, right, we're going to have some assumptions on the world that will deal where we're living in. Okay, and we're going to start with a very simple world without a lot of important frictions that could change our interpretations on why companies want to finance the way it is, right? Why companies want to fix the balance of debt and equity as it is, right? And then we're going to gradually introduce some important frictions into our perfect world, right? Into our frictionless world. And then we're going to talk about how those frictions is going to change our understanding on the Modigliani and Miller theory. Okay, so that's sort of the plan, right? The first slide, or slide number 12, is going to be about, how to understand capital structure using the Modigliani and Modigliani and Miller theory in a perfect or in a simple world, or in a perfect capital market, right? That means the same thing. And then the next slides, we're going to talk about Modigliani and Miller theory, right? Including those important factors or important frictions, and see if that changed our understanding on the balance of debt and equity. Okay, so let's get started. So the outline of this slide, right, like I explained, is that we're going to start talking about the third, right, the third and probably more important part of corporate finance, right. And by talking about capital structure, right, by explaining the science behind the balance of debt and equity, we're also going to engage a lot of topics under corporate governance, right, meaning how to manage the conflicts between different parties. Right? So they are essentially connected, right? Connected with each other, right? So previously we've explained, remember some other topic like capital budgeting, right? And external financing, right? And today we're going to come into the world of capital structure, and let's see how Modigliani and Miller understands, the balance of debt and equity, right? In their seminal paper. So what is capital structure, right? The mix of debt and equity, right? And if you remember the formula for WACC, right? When we calculate the overall cost of capital, it's essentially a weighted average of cost of equity, ROE, and cost of debt, right? ROD, right? So, an example is on the graph on the right-hand side, right? So if we have company that have financed, all its capital using 35% of debt and 65% of equity, this is how the capital structure looks like, right? And if you want to compare the capital structure across different firms, we can use a ratio, which is calculated using, the value of debt divided by the value of equity, right? And sometimes, a lot of times, we call it a leverage ratio, right? So for each firm, we will have this D over E, right? This leverage ratio, and we can compare this leverage ratio across different firms to determine, how much debt or the amount of debt, right, in terms of equity that they have raised for the firm. Right? Is it a leveraged firm? Is it a high leverage firm, or is it a low leverage firm? Right? We're going to use this leverage ratio to compare across the firms. And so now the question is that why do we even care about this ratio, right? So we know that there are two ways to finance, right? And we talk about how to finance for each way, right? Why do we care how much debt to raise and how much equity to raise, right? And actually, this is a very important question, right? So let's take a look at an example company, which is a company that everyone likes, right? At least I like it, right? And the company is has a very simple business model, right? Which is to sell burritos, right? Sell food, right? And fresh food, right? Hopefully. So let's take a look at Chipotle's company's leverage ratio, right? So On the left-hand side, right, on the right-hand side, there's a graph, right? So I want to first point you to the fact that actually Chipotle has been managing its businesses without any leverage, right, before 2018, right? And in 2019, it secures 600 million credit line, right, because it wants to prepare for the coronavirus crisis, right? So at that point of time, it started levering up because it wants to hold some cash, right, to buffer for the the COVID shock, right, to their business. Right, that's exactly when the leverage increases from almost zero, right, before 2018 to somewhere up above 50%, right, between 50% to 60%, right, in terms of its total assets, right, in 2019, right, in 2019, right. So this is an example of company, right, changing its capital structure, right, meaning changing the balance of debt and equity, right, because based on the valid reason, right, based on the valid reason that the company forecasts, right, during COVID, it is likely to experience, a very negative shock on its business, right, and then it started borrow from debt, right, instead of issuing equity to hold more cash so that it can survive this crisis, right? So the question, right? Again, the question here is that why doesn't it issue equity and instead issue debt, right? So this is something that we're going to try to understand for a company, right? Why is there a preference for using debt or using equity, right? And then what should the company's preference be, right? To determine their leverage ratio, right? The ratio or the balance between debt and equity. Right? So this is actually a very important question, and people have been thinking about it for a long time. Okay, so if you look at the history of U.S. companies from 2020, from 1920 to 2010, right, over the past 80, 90 years, right, what we observe is actually increasing leverage ratio, right, over time, right? So the average debt to capital, right, right, either estimated by total debt over total capital or total long-term debt, right, divided by capital, right, they have a very similar trend, which is increasing. Actually it falls a little bit, right, from 2019 to 2040, right, from 15 maybe falling to somewhere around 10%, right, and then it started to increase, right, all the way till almost 40%, right, almost 40% in late 1990s, and reduce a little bit, right, in 2010, right, to around 40% or 35%, right. Similarly, if you use liabilities, right, if you use total liabilities instead of debt, right, divided by assets to measure sort of this leverage ratio, then you can find that company actually have more liabilities over time, right, from 1920 to 2010. Right? So why is that happening, right? Why is that happening, right? Why would companies prefer, right, find a better preference on debt instead of equity, right, throughout the history of U.S. U.S. Finance history, right? So over the past 80 years. Right. So this is a very important question that people have been trying to address, right, in the finance journals, right? And also, if you look at the cross sections, meaning if you do a snapshot, right? If you do a snapshot of all the companies, and then you put them in different industries, and then this is basically what happens to different industries, right, for their leverage ratios at the same point of time. Right. So we observe that at same point of time, there are some industries on average, their leverage ratio is very, very small, right? Maybe less than 10%, right? So particularly for those IT firms, right? Internet software service, right? Internet related, and also apparel retail, right? Think about, Gap, right? Apparel retail, think about maybe Zara, right? And also followed by oil and gases, right? Utility companies, right? System software, computer storage, right? So a lot of IT companies in the beginning, right? And in the middle part, right? In the middle part, we have diversified metals and mining, auto part equipments, right? Mostly manufacturing companies, right? And then we have healthcare services asset management, custody banks, right? Hotels, automotive retail, right? And some other industries. And in the end, right, we find that there are some industries on average have more than even 50% of leverage ratio, meaning that debt composes more than half of the total financing, right? And those industries are like electricity, utilities, tire and rubber, also some manufacturing companies, right? Marine, healthcare facilities, independent power producers, energy traders, right? So you see that it seems like there's no general pattern of what sort of company, right, will have what kind of leverage, right? But for different industries, right, they do have a difference, right? And sometimes a very large difference if you consider the top and the bottom ones, right, in terms of leverage ratios. Meaning that depending on different type of business nature, right, you probably want to think about a unique leverage ratio that fits, right, your business model. Okay, so on the right hand side we have an examples of two companies, right? Intel and ARM Holdings, right? So they are similar companies that are related with that are both working on these semiconductors productions or the chip productions, right? So Intel has a 10% leverage, right? Meaning that among all the financing, that compose 10% of the sum of equity and debt, right? And the equity covers the remaining 90%, right? However, for ARM Holdings, it's 100% financed by equity, right? No debt at all, right? So why would two companies in the same industry actually choose a leverage that is different from each other, right? So that's also an interesting question that we want to address, right, in this lectures, right? So the question is, how much debt, right, should the company raise, right? What is, how do you make sense out of it, right? Well, and equivalently, right, the equivalent question you ask is that, does leverage actually have an effect, right, on firm value, right? And if the answer is yes, right, so what should be, right, the optimal leverage ratio for maximizing our firm value, right? So before answering that question, we might want to know first how to define or calculate firm value, right? So in this case, firm value is basically the total value of financing from debt and equity, right? So for a levered firm, right here, right, I use the notation of a capital letter L, right? To represent a firm that is levered, right? Meaning a firm has a positive debt value, right? So a levered firm, right? The value of a levered firm, V of L, should be the value of the debt plus the value of the equity, right? So here, remember, it's all market values, right? The market value of debt plus the market value of equity, right? Or if it's a company that's totally financed by equity, it means that it's unlevered, right? Meaning that there's no leverage, right? So I use a U, right, to represent a company that is unlevered, right? Or the part of equity that is unlevered, right? So in this case, V of U would just be the total value of equity, right? So here you might have a question, right? So what about cash, right? So a lot of companies hold some level of cash, right? And should we count the value of cash, right, in the firm value, right? And the answer is yes. But instead of counting it as positive, we actually count it as negative, right? So here it might, it might be a little bit confusing to understand at first why we count cash of a company as a negative value, right, over here, right? So so actually here, right, you can think of this value of debt, right, which is D over here, as the net debt, right, which is the difference between the market value of debt and the amount of cash and cash equivalents that a company holds, right? So here's how to think about this, right? So there are two ways to think about how we understand cash as sort of like a negative debt, right? Because we subtract it from the amount of debt, right? So consider cash as the ability or the liquidity for the company to immediately reduce the debt, right? So you have borrowed from your lenders and you have keep the amount of money, which is cash, right, in your own pocket, right? So if you immediately, right, pay back your debt using your cash, then the amount of debt that you actually have is actually smaller than the total value of the debt, right? That's what net debt means, okay? So another way to think about cash, right, why the value should be negative, right, on firm value, is that if you think about, acquiring 100% of a firm, meaning that let's say you're the CEO of company A and you're looking at company B and thinks that maybe I want to acquire it and then it will provide value, right, for our company. So how do you buy a company out, right? How do you entirely acquire a company, right? So first of all, if it's a company, right, then you want to buy all of its equity, right? So let's say you want to buy 100% of it, right? So sometimes you don't need to own 100% of it to control it, right? But let's say in this case, you want to completely, entirely buy that company out, right? So what you need to do first is that you need to own all its equity, right? So if the company's value is D plus E, right, you need to first acquire all its equity, which is represented by E, right? So you need to spend the amount of money of E to buy it, right? And then after you own the company, you're also entitled to pay back its debt, right? So if you want to get rid of the debt, you need to spend another amount of D, right, to pay off all the debt, right? So however, if you have acquired the company, the cash of that company is also yours, right? So before paying out your debt, you can actually use the cash, right, to pay some amount of the debt of that company, right? So the logic is like this, right? Think about the value of a company, right? The value of a company is the amount of money someone needs to spend to buy it, right? How much do you need to spend to buy a company? Well, you first need to spend the amount of E, right, which is the equity, right? And then you need to pay the amount of D, right, for its debt, right? However, you can use its cash to pay for some amount of its debt, right? So you should have spent D plus E minus debt, right, to acquire the total of that company, right? So this is why enterprise value is defined here as D plus E. However, D is not the total debt, rather it is debt less cash, which is net debt, right? So you can think of enterprise value as D plus E minus cash, right? However, we want to, I want to, highlight here, right? So D is always net debt, right? In the future slides. Okay, we consider D in this case in capital structure always as net debt, right? So if I don't mention cash, you will know that D is already after adjusting cash. Okay, so that's something that I want to point out over here, right? In case we get confused in the future, right? So if you think about cash, right, D is already adjusted by cash. Okay, so this is basically how we value a company, right? So this is firm value, right? So now we know how to value a company, and we want to answer the question that if leverage ratio or capital structure has an impact on firm value. Okay, so and to answer this question, these are the two people who first give their try and provide a very good model in answering those questions, right? Modigliani and Miller, right? Franco Modigliani, right, who won Nobel Prize in 1985, and Merton Miller, who won the Nobel Prize in 1990, right, because of their contribution in corporate finance. Okay, these two are essentially the founding fathers of this subject of corporate finance, right, because of this theory, right? And after this theory, about corporate finance, a lot of people followed on their steps and perfected these models and theories on the other topics as well. Okay, so these two people, right, you should remember their names, right? Modigliani and Miller, right? Together, M&M, right? A funny name. Okay, so this is what we call it, right? M&M theory, right? M&M theory. So they provide an explanation, right? This theory provides an explanation for three questions, right? Three very important questions, right? First of all, how leverage will affect firm value? Okay, how leverage will affect firm value? And second of all, how leverage actually affects the equity risk, right? And the short answer is that when leverage increases, equity risk also increases, right? So they have a positive relationship. And the last question is related with payout policy, right? Meaning that how differently companies pay out the money to their investors will affect the firm value, right? Will affect the firm value, right? So on capital structure, right? Capital structure is only related with the first two questions, right? While the third question is sort of related with another topic, which we'll think about whether we have time, right, to talk about it, which is about policy, right? Payout policy, right? So the first two about the capital structure and their strategy in answering these questions is like what those people who study physics do, right? So they want to first isolate, right, the most important stuff, right, for this capital structure by basically ignoring or assuming away those frictions, right, that could somehow impact our understanding. Right? So like in physics, right? If you want to, have a theory about how objects move, right? Or about how to estimate the force, right? Or speed, right? So you need to think about a world without, frictions. For example, air frictions, for example, frictions from the surface, right? So let's ignore those frictions first and think about what the object should be moving, right, in a world without any frictions, right? It's a similar logic for M&M theory, right? We want to assume that we're living in a capital market or we're living in a world that is sort of perfect, that does not have any frictions that could delay or make it more costly for investors to trade, for investors to negotiate. Okay, and then right, after we figure out what this theory is about in the perfect world, right, we'll add in some important frictions that happens in the real world that we cannot ignore, right, and see how those frictions is going to influence our decisions judged from Modigliani and Miller theory. Okay, so let's first define what a perfect capital market or a perfect world is. Okay, so this is a capital market that does not have any taxes, right? No taxes on individuals, no taxes on capital gains, no taxes on corporate, right? No corporate taxes. Okay, and then let's assume there's no transaction cost. Okay, for example, if you buy stock from a brokerage, then the brokerage a lot of times will charge you for their service, right? Which is considered like a transaction cost, right? So let's say there's no transaction cost, meaning that investors don't need to pay the intermediaries any premium for their service. Okay, and let's also assume that there's no bankruptcy cost or no financial distress cost, right? Meaning that even if a firm lever up to a very high leverage, people will still have the same trust or same belief in that company, in its ability to pay back its debt. Okay, so essentially there's no financial distress cost, right? And then let's also make some other assumptions, right? Such as firms and investors can borrow and lend at the same rate, right? Which normally does not happen in the real world, right? Institutional investors are at advantage than retail investors in a lot of cases, right? And then if you want to borrow money from a bank, then individual investors are likely to incur a much higher interest rate than a company, right? So let's assume that's not the case, right? And also let's assume everyone has the same information on everything, and there's a perfect computation, right? No one is trying to let's say there's no monopoly, right? No imperfect computation, right? Everything is competitive in the market, right? So this basically gives us a very perfect or very simple world to understand companies, right? Without those frictions, right? And let's try to start from a world like this and think about how debt and equity will have the impact on the firm value. Okay, so in this perfect world, Modigliani and Miller theory basically have this proposition one like this, right? So in the first perfect world, in a perfect world, the total value of the firm is actually independent of its choice of capital structure, right? Probably no surprise to you. Right? So Merton has a very famous quote, right? Merton has a very famous quote like this: picture a firm's total market value as a pizza, right? No matter how many slices you carve it up to, the size of the pizza remains the same, right? So basically what it means is that, no matter how much debt or equity you put, right, in the pizza, the size of pizza does not change, right? No matter how much pepperoni or how much, Hawaii pieces you put into that pizza, right? It does not change the size of the pizza, right? It does not change the size of the pizza, right? So how do we prove it? Right? How to prove it? So let's assume we are looking at a firm that is levered, right? Meaning that the value of the firm is the total of its equity and debt, okay? And remind here, debt here is net debt, right? So we're not thinking about cash here, okay? So 100% equity or an unlevered firm will have, a value V of U, which equals to EU, right? Let's assume we started from 100% equity financing, right? And we start by raising our debt of amount of D, right? And use it to buy back our outstanding equity, right? So remember, after you raise debt, right? After you borrow money, you will have amount of cash, right? And I don't want you to sit with the cash and not use it. And I want you to use that cash to buy back equity, right? So what will happen is that, we will have, an outstanding value of D, right? However, we will have a smaller equity, which is going to be E of U minus D, right? Because we spend the money of the cash to buy back its equity, right? And so now the new firm value will be V of L, right? V of L, meaning this levered firm with the newly issued debt should have a firm value of, value of D plus, the original value of equity, E of U, minus the amount of money that we spend to buy the equity back, which is amount of D, right? So if you break the bracket, it's D plus EU, E of U minus D, right? Which is E of U, right? So E of U is the original value of the unlevered firm, right? So this essentially gives you this equation that V of L equals V of U, right? In this case, right? Equals V of U in this case, right? So remember, there's no corporate taxes, right? So there's pretty much no benefits of raising debt on top of raising equity, right? So the value of the levered firm with debt equals the value of the firm actually without debt, right? Before and after you raise, new debt, right? So the conclusion is that issuing debt in this case will not have any impact on the firm value, right? Capital structure does not matter, right? In this case, right? No matter how much debt you raise, right? So let's take a look at an example with numbers, right? And let's see, if it makes sense, with the numbers. Suppose we have a company that's called XYZ, right? It's a 100% equity finance company, and the market value of the equity is, let's say, 500,000. Okay, so now it raises $50,000 from the debt market. Let's say it issued a corporate bond and successfully raised a 50K, right, from the debt market, and used all this amount to buy its share back, right? So here, if you have a question on why we want the company to buy the shares back, right, then pretty much you have to use somehow you need to use the money you raised from the debt market, right? So if you want to put it like cash, if you want to keep it like cash, then net debt is pretty much zero, right? Because you raise this amount and you keep it as cash, right? So net debt in this case will be zero, right? So if you don't want to keep it as cash, well, another thing you can use it, or another way you can use it is to buy back your equity, right? Is to buy back your equity, right? And so maybe another question you have is that, well, can we spend the cash into our investment, right? Can we invest this amount of money in a new project? Right. So here, right? So here, remember, we're talking about capital structure, meaning that we want to isolate the decision of making investment from the decision of changing our capital market, from the decision of changing our capital structure, right? So this is similar like when we do capital budgeting, right? We want to make sure we isolate our investment decisions from financing decisions, right? So in this case, we're purely talking about financing, right? So we want to isolate our financing decisions from our investment decisions, right? So we cannot use that money issued, right, for new investment, because here we just want to completely ignore the fact that our investment is going on, right? Some other investment is going on, right? So you raise that money, you either keep it as cash or you can use it to buy back your equity, right? Or you use it to pay back your debt, which has no point at all. Right? So in this case, let's assume you raise the debt and you use the money you raise from borrowing to buy back your equity, right? So if you have done that, then the equity will have a remaining value of 450,000, right? And then you will now have an outstanding debt to pay back, right? To pay back. So what happens to XYZ after this debt issuance and equity buyback is that its leverage ratio is going to increase, right? From 0, right, to 50,000 divided by 450,000, right, which is 1/9, right? So its leverage ratio definitely increases because it used to be a 100% equity finance company. However, now it has outstanding debt and outstanding equity together, right? However, firm value is going to remain the same because we have a smaller equity. However, we have higher debt, and the total value of these two is still what it was before, right? For the total value of market equity, right? So in this case, right, in a perfect capital market, capital structure actually does not have any influence on firm value, right? On firm value, and we have just proved that. Just prove that, right? So there's actually another proposition, right, from the same theory, right? Modigliani and Miller, proposition 2, right? So what does this proposition 2 talks about, right? It says that leverage, although does not have an impact on firm value, it actually increases the cost of equity. Okay, it actually increases the cost of equity, right? How do we think about this, right? So when firms lever up, right? When firms lever up, think about this. When firm levers up, well, you need to pay a higher amount of interest expenses to your debt holders, right? You need to pay a higher amount of interest expenses to debt holders. So what happens is that the residual value for equity, right? The residual value for equity holders becomes smaller, right? So in this case, right, the risk of equity holders becomes higher because it is very likely that when something bad happens, the company will default on its debt payment, so that equity holders will get nothing, right? So equity holders will get nothing, right? So how do we quantify this relationship, right? This positive relationship between leverage and cost of equity, right? So now we have an equation, right, in the proposition 2. Okay, the cost of levered equity, R of E here, right? So here, R of E means cost of levered equity. Okay, so cost of levered equity equals cost of unlevered equity, right? R of U here is cost of unlevered equity. So you want to know that they both means cost of equity. However, R of E is cost of levered equity and R of U is cost of unlevered equity, right? So just, spend a little bit of time with the notation, right? Plus D over E, which is the leverage ratio, right? Multiplied with the difference between R of U minus R of D, right? So if you think about it, it's a little bit similar with the CAPM equation, right? It's a little bit similar with the CAPM equation, right? So what it means is that the levered cost of equity is a linear function of the difference between unlevered equity and the cost of debt, right? Unlevered equity and the cost of debt, right? So, take a moment to sort of comprehend it, right? So what this equation means is that higher D over E, higher cost of levered equity on the left-hand side, right? Higher D of E, higher cost of equity on the left-hand side. Right? So how do we show this formula, right? Where does this formula come from? Let's take a look at these equations, okay? So there's nothing hard. Okay, I'll explain step by step, right? So hopefully at the end, you'll make sense out of this relationship. And if you don't remember that formula, right, instead of looking at the formula sheet, maybe you can derive it yourself, right? So think about this, right? Remember, a return of a portfolio is simply the weighted average return of each security, right? So the weighted average of cost of capital for a company, right? The weighted average cost of capital for a company, or the WACC that we have learned about, right? So in this case, let's use this R of L, right? R of L to represent WACC, right? Which is the cost of capital for a levered company, right? R of L. Right? So R of L equals a weighted average of cost of cost of equity and the cost of debt. Right? Very simple. In this case, we don't have taxes. Remember, in the perfect capital market, so we just have a simple weighted average. No need to adjust for the tax effect. Right? So let's say since we have proposition one that shows actually firm value remains unchanged after issuing debt, right? And if we write the firm value, right, in this case as V of L for the levered firm, which is the free cash flow divided by the discount, right? The free cash flow divided by the discount, right? And then if our investment decisions remain the same, our free cash flow will not change, right? So our free cash flow will not change. So our free cash flow for a levered firm or the unlevered firm before, it should be basically the same, right? So from proposition one, V of L should be equal to V of U, right? So what we can derive is that, when free cash flow remains the same, our denominator should also be the same, so that V of L would be V of U, right? So if our denominator are the same, it means that the levered cost of capital, right? The levered WACC should be equal to the unlevered WACC for a company, right? The levered WACC should be equal to the non-levered WACC, right? So what does that mean? It means that R of U, right, which is the unlevered WACC, should be equal to R of L, which is a levered WACC, which can be expressed, right, in the WACC formula like this, right? So R of U would be equal to R of E times E over E plus D plus R of D times D over E plus D, right? So, and if we do some algebra out of this equation, we will see that, right, if we move R of E to one side and move everything else to the other side, right, we will see that actually R of E equals, right, R of U plus D over E multiplied with the difference between R of U and R of D, right? So this is where this formula comes from, right? A simple application of the WACC formula, and also with the support of proposition one that firm value does not change, right? Does not change in capital structure. Right? So here we arrive at this conclusion that the cost of equity or equity risk will actually increase, right? In leverage ratio, right? In leverage ratio, right? So this is what proposition two says, right? So now, this is basically the implications, right? The implications for this proposition one and proposition two in the perfect capital market is that, well, capital structure is not interesting at all, right? Because no matter how much debt or equity you issue, firm value doesn't change, right? Firm value doesn't change. And even though equity risk increases in the leverage, WACC does not change, right? WACC does not change, and the investment does not change either, right? Because it's not a part of your financing decisions, right? So in a perfect capital market, we shouldn't care, right? We shouldn't care about leverage. We shouldn't care about leverage ratio, or we shouldn't care about capital structures, right? So if you think about this like what you learn in physics, right? So something similar is sort of like what Galileo has said about objects falling at the same rate, right? Objects will fall at the same rate independent of their mass, right? If there are no air frictions, right? Or in a vacuum world, right? So no matter how big or how small it is, right? In a world without air frictions, they should all fall at the same rate, which sounds pretty perfect, right? Which sounds pretty perfect. So this is exactly what we learn from a perfect capital market without those frictions on capital structure. And this sort of lays the foundation for corporate finance, right? In understanding, the capital structure decisions, right? So we learned that, from Modigliani and Miller's theory that, in the perfect capital market, things does not matter much, right? Well, for determining the balance between debt and equity, right? So now the question is that why companies still choose, to make decisions, right, of changing their capital structure or remaining some sort of capital structure along the way, right? So this is because that there are also, many important frictions that could change our conclusion on capital structure, right? And then we will talk about, some important frictions or important factors that happens in the real world, which are not counted in our perfect capital market. And we're going to add them one by one into our Modigliani and Modigliani and Miller theory. Okay, and we're going to see how that will, change our interpretations on companies' decisions on capital structure. Okay, so that will be in the next slide. Let me change this to 13. Okay, so very good. Actually, we're almost there. Right? We're almost there. So let's talk about the real world when things are slightly more complicated than what we imagine in a perfect capital market. Okay, so remember previously we talked about proposition 1 and 2, right? A quick review, right? In proposition 1, it says that in a perfect capital market, capital structure does not matter, right? Proposition 2 says that leverage actually increases the cost of equity. And however, it is the fact that leverage does not increase the overall cost of capital, right? So next, we're going to talk about 4 types of frictions, right? So the first, which is kind of one of the most important one, right? We have ignored in the perfect capital market. Which is about corporate taxes, right? Or all kinds of taxes, right? And the second one is called cost of financial distress, right? Meaning that it is not a very wise decision for companies to increase their leverage to a very high level because at that point of time, when people or especially investors and or customers who are afraid that or who is concerned that your company could be going into bankrupted, then there are further costs, right, associated with financial distress. And also, we will add into the factor on agency cost or agency issues that we have previously explained, right? Meaning that different people have different incentives on what they want, right, from out of the company. Right? And sometimes there could be conflicts of interest among different parties, and which will lead to inferior decision for the company. Right? And in the end, we have asymmetric information. Right? We just recently talked about external finance, meaning that different parties have different information and how that will lead to a different decision on capital structure. Right. So the question is that if we add those frictions, what will the proposition still hold, or how will the proposition change into, right? If we have considered those. So remember, these are the first, the 2 propositions, right? Actually, the third proposition is about dividend payouts, right? About payout policy, right? Which we don't cover here. So let's continue. We can always come back, right, to look at this, right, when we talk about adding different frictions into it and how that will change, right, our propositions. Okay, so 4 type of frictions, right? 4 type of frictions. Let's first talk about corporate taxes, right? Corporate taxes. Corporate taxes is pretty straightforward, right? As we've seen multiple times through this course, in reality, corporate tax has an important effect on firm value, right? It affects a large amount of companies' revenue or companies' profits, right? The effect, right? The effect for taxes is that it is not related. It is rather not related with equity. However, it is much more related with debt, right? Meaning that actually raising debt has this benefit of tax deduction, right? Tax deduction, because interest payment is made before tax is estimated. So a higher debt would actually benefit the companies by paying less taxes. Right? So the reduction in tax payment will sort of increase the overall amount available to all the investors. Right? So it will increases the firm value. Okay, it will increase the firm value, right? So let me show you how it's done. Right, let me show you how it's done, right? So here, you want to remember that firm value is not only the market value here, okay? So if you think the firm value is the market value of the equity, then you probably want to think twice here, right? So firm value actually is the total value that goes to both equity holders and debt holders, right? Remember, it's D plus E, right? Instead of just E, right? So here, let me explain using an example, right? So we have two companies, let's say we have a company, right? Same investment, right? Meaning that it will reach the same EBIT, right? Earnings before interest and taxes, right? So in one case, it is levered, and in the other case, it is not levered, right? So when it has a positive leverage, it needs to pay an interest payment of $300, okay, which is paid to debt holders, right? And without leverage, it doesn't need to spend any money on interest expenses, right? So with leverage, it has a smaller income before tax, meaning that it will have a smaller tax payment, right? And the net income, right? The net income is also smaller compared with a company without leverage, right? So notice that interest payment decreases net income, right? Meaning that less is available to equity shareholders, okay? But more on the other side is available to debt holders, right? So remember, we're interested in what available to all stakeholders, right? Both equity and debt, right? So in this case, right, let's look at the second table, right? So with leverage, $300, right, of interest payment is paid to debt holders, and 539 are paid to equity holders. So in total, the total amount of value of money went into both type of investors is 839, right? Compared with 734 that only goes into the pocket of equity holders, right? So in this case, this is why leverage, right, to some extent will increase firm value, right? Will increase firm value, right? So where does this extra $105 come from, right? The amount available to all investors is increased by 105, right? So another way to think about this is actually you can use the tax shield, right, from the interest payment to calculate this number, right, to find this number, right? Tax rate is 35%, right? As we have, done this in the homework question, right? We pay $300 as interest payment, and 35% of that is exactly 105. Right, 105. So this is exactly what is extra, right, going into investors, going into all the investors, right, particularly to the debt holders, right, to the debt holders. So we introduce here again, right, the formal way of doing a tax shield, right, of calculating the tax shield, right, which is corporate tax rate times the amount of interest payment. Right, the amount of interest payment. So if you want to take a better look at where this money is from, right, you can actually see it from this graph, right? So we have a pre-tax cash flow, which is the green bar, which is the EBIT, right? So and we need to for unlevered firm, we need to pay a large amount of taxes, right, to the government. However, if you lever up, right, if the firm levers up, then we have a smaller amount of value going to the equity holders. However, a larger amount of money going into the debt holders and less tax, right? And less taxes. So the total value of the company increases by the amount of what the red arrow has shown. Right? So what is the incremental value of this interest tax shield, right? So the way we want to calculate, right? So if you want to calculate the value, right, the extra value that was brought in by this leverage on top of the total firm value, right? Because look at this way, right? So this is sort of like a periodic incremental value, which is $100, $105, right? How do we calculate the total value, right, of all the future interest tax shields, right? So it's very similar like how we calculate annuity or perpetuity, right? We calculate the present value of all of those and we add all of them up, right? We add all of them up. So with taxes, theory's proposition 1 essentially changed into something like this, right? The value of a levered firm should be the original value of the unlevered firm plus the total net present value, right? Or the total present value of the debt tax shield, right? The total value of debt tax shield, right? So to compute this present value of debt tax shield, right, we need to forecast the firm's debt and therefore its interest payment, right? And we need to forecast the changes in the amount of debt outstanding and also the changes in the interest rate on that debt, right? And then we discount them at a rate that corresponds to their risk, right, back to the present, right? So let's take a look at this example, right? So suppose this is a company that have borrowed $2 billion by issuing this 10-year bond at par, right, meaning at its face value, right? Then this cost of debt is 6%, so it will need to pay this amount of interest each year for the next 10 years, right? So here, let's sort of like think about this cost of debt as sort of the interest rate, right, or yield to maturity it needs to pay. So for the next 10 years, and then they need to repay the principal amount of $2 billion at the end of year 10, right? Its marginal tax rate is 35%. How much does the debt tax shield increase the value of ECB? Right. So first of all, you need to know that the principal payment does not count as the interest payment, right? Meaning that there's no tax benefit from the principal payment. Right? All the benefit come from the interest payment, right? So you essentially can think of this interest payment as an annuity, right? As an annuity. So each year you need to pay 120 million times what? Let me take a look. Yes, so each year you need to pay 120 millions in interest expenses, right? Meaning that each year the benefit, right? The benefit or the tax shield from paying this interest payment is 35% times 120, right? Which is $42 million, right? So each year you are actually receiving, the benefit of raising from debt, right? Of about $42 million, and this payments will last about 10 years, right? For each of the 10 years, right? So as the present value of annuity, it will be calculated in this formula, right? Which is about $309 million, right? So the total value of the new company with the leverage should be $309 million higher than the company that doesn't issue the company that have not issued this bond before, right? So it increases the firm value by $309 million because of the tax benefits. Okay. So this is sort of the applications on how to think about tax benefits, right? In terms of the proposition 1, Modigliani and Miller theory. Right. So in reality, right, let's talk a little bit more about how company actually deal with the debt. Right. So very rarely would company, issue a bond, wait for 10 years, and then pay back the total amount of its principal at the end of the 10 years. Right. And instead, what companies often do is to refinance this debt at the end of its maturity. Right. So basically, what happens, you can think of this debt sort of like a forever debt, right? A debt perpetuity. Right. The companies will keep making periodic payments and never pay the principal payment, right? So at the end of its maturity, it will likely issue another debt, right, to replace of its current debt, right? So if you do that, you can use the money that you raise from the new debt to sort of pay back your original debt, or you can just negotiate with the bank, and you can talk with the bank and say, let me refinance this debt, right? And I'll keep paying you interest, but we're gonna delay this principal payment at the end of another new maturity, right? So this is basically what companies are doing, right? All the time, right? So they will extend the maturity of their existing bonds or existing debt, and keep paying a regular payment, right, till forever. So if you think about that in this case, right, it is more, it is easier for us to think about the present value of the tax benefit, right? You can sort of think about it as a perpetuity, right? The tax benefit is, a very similar payment, right, which happens periodically until forever, right? And then the present value of the interest tax shield could be calculated using a perpetuity formula, right, which is the amount of D, right, which is your total debt face value, right? It's total debt value, right, multiplied by the cost of debt, right, to give you the interest payment, right, and then you multiply that with tax rate, right, which gives you the tax benefit, right, for each period, right, and then you divide it by the cost of debt, right, which is sort of discount rate for that payment, right, and if that happens, you can sort of take off the R of D in the both denominator and the numerator, and you end up with something like D multiplied by the tax rate, right? So the present value in this case is very simply estimated, which is the total value of the debt multiplied by the tax rate, right? Multiplied by the tax rate, right? And if you think about that, right? So R of WACC, right, is the pre-tax WACC, right, minus the R of D times the tax rate, right, times the weight of the tax, right? So in this case, this is how WACC is calculated when we consider the tax benefit of that, right? When we consider the tax benefit of that. Right? So similar stuff will also happen to proposition 2, right? Similar stuff will also happen to proposition 2. If you write out your WACC in this case, right? If you write out your WACC in this case and set it equal to R of U, right? And set it equal to R of U. Wait, not equal to R of U. Let me think. Yeah, use the same fashion as what we did, right? To express R of E in terms of R of U, right? So this is what you get, right? I'm going to save the derivation, right? For simplicity here. But what we can end up with is a formula like this, right? It's very similar with proposition 2 in a perfect capital market. The only difference is that we need to put another adjustment for taxes, right, behind the bracket for R of U minus R of D, right? So let's take a look at an example, right? Suppose a firm is currently completely financed by equity, right? 100% equity. The cost of equity is 10%, right? The cost of equity is 10%. And then the market value of the equity is $100 million. Right? XYZ is thinking about raising this amount of debt at a cost of 5%, right? With a tax rate of 40%. How is it expected to change the cost of equity for XYZ, right? Meaning that, what will happen to the cost of equity for X, Y, and Z, right? What about its new overall cost of capital, right? So let's take a look at the proposition 2, right? Using the formula of proposition 2, right, we can plug in the formula with the numbers, right? R of U is cost of unlevered equity before, which is 10%, right? Which is 10%, right? And the weight or the leverage ratio is $50 million divided by $100 million, right? Divided by $100 million. Okay, so I apologize. I just found an error found a mistake in this example. So now I've rewrote the example and then rewrote the solution. So right, so let's take another look at this example, right? So suppose XYZ is solely financed by equity, right? And it has a cost of equity of 10%, and it has it's thinking about raising $50 million new debt, right, at a cost of 5%, right? And instead of keeping it as cash, right, we want to use it to buy back its equity, right? Because otherwise you're going to sitting on a pile of cash that's worth of $50 million, right? So essentially your net debt in that case will become zero, right? So there's no point of keeping it as cash, right? So if we buy it, right, if we buy the equity from the market, right, using the amount of debt that we have raised, then our equity will become 50 instead of 100, right, after this share buyback, right? So assume a tax rate of 40%, right? What will be the new cost of equity for XYZ, and what will be the new overall cost of capital, right? So if we use the formula from proposition 2 with taxes, right, we shall calculate the new cost of equity, which is, R of E, which is equal to 10% plus, the $50 million of debt over $50 million of equity, right, times, cost of equity, levered equity minus cost of debt, right, times 1 minus the tax rate, right, which will be equal to 13%, right? So, it is higher than 10%, right, meaning that, equity risk has increased by, leverage, right? And let's take a look at its WACC, right? WACC is calculated using the WACC formula, right, which is, the new cost of levered equity, right, which is 13% that we just calculated, times 50, right? 50 of $50 million, right? So in this case, $50 million of equity value divided by $100 million, right? Plus 5%, which is cost of debt, right? Times $50 million divided by $100 million, right? Adjusted by the tax rate, right? So the result will be 8%, right? Which is actually smaller than the WACC that, which is basically the cost of equity of 10% before, right? Remember, for the firm without any debt, the WACC is basically just cost of equity, which is 10%, right? So now we've reached another WACC, which is smaller, right? Which is actually smaller than the previous WACC, right? Because now we have factored into the consideration of cost of debt, right? Which is essentially smaller than cost of equity, right? And then, on the other side, right, we have a higher firm value because of this debt, right? So it corresponds to a smaller levered WACC, right, which is 8%, right, less than 10%. Okay, so if the tax advantage of a debt is so good, right, why won't the firm just do 100% debt, or do a 99% of debt, right? So why don't you see that in the real world, right? And explanation is there's something called cost of financial distress or bankruptcy costs, right? So these two basically refers to the same thing, right? So what is cost of financial distress, right? So there are, indirect costs and direct costs, right? So direct cost is, if, right, let's suppose if the company goes into bankruptcy, then you need to go through a procedure. Well, you either want to liquidate your company, right? Basically, liquidate whatever asset the company still has and give it to the debt holders, or you want to go through, a Chapter 11 reorganization procedure, right? So both procedures are very costly, and both procedures very costly, right? So if you indeed, want to file a bankruptcy, there's actually a lot of money that could be wasted instead of going into the pockets of your investors, right? So this is like the direct cost of financial distress, right? So you might have a question that, well, the firm has not gone into bankruptcy yet, right? So why is there this direct cost? Well, the thing is that, this is something that is, likely to happen in the future, right? If the company has increases leverage by too much, right? And if it happens, this is basically the money you need to spend, right, for this to go through. And debt holders do worry about going through this procedure because it is very bad for their investment, right? It is very likely that they're going to lose a lot of money because going through this bankruptcy procedure, right? So it's sort of like what we consider as this direct cost, right? So there are a bunch of indirect costs, meaning that when your firm has too much leverage and your customers and your suppliers may be worried that you are not going to be able to pay back their money, right? You're not going to be able to pay back their money. You're not going to be able to supply to give them their supply, or to pay for their goods, right? And also your employees will worry that probably you cannot afford their wages, and they will be laid off, right? So some reaction is that you'll probably start finding new jobs themselves and leave by themselves, right, instead of getting laid off, right? So think about all these airline industries, right, during the COVID situation, right? Because the companies has very little revenue anymore. However, it needs to face, a very high leverage, right? It needs to face a very high amount of interest payment, right? So what happened is that, a lot of times it will sort of reduce its burden by laying off a large amount of employees, right? So this happens a lot, right, in during COVID, right, from many different companies. So, and also, if you are thinking that if your company is in financial distress, right, it's likely that if you seek liquidity to pay your interest payment back, right, to pay your debt holders, you will need to actually liquidate some of your assets, right? And if you need, immediate liquidity, right, if you really require this liquidity, then you might want to sell your assets in large discounts, right? So this is what we mean by saying fire sales, right? Fire sales meaning that you're selling your assets in a distress, right? Meaning that you want to you are basically selling your assets at a value below their fundamentals, right? Because you really need a quick liquidity, right? So, and this can also hurt the company's value, right? And finally, if you are already having a very high leverage, it's very hard for you to raise additional money, right, anymore, right? Because investors are also concerned that if your company goes into bankruptcy, they will lose a lot of money, right? So it will essentially increase the cost of, raising further capital, either through debt or equity, right? Either through debt or equity. And so those are all the costs, right, for financial distress, meaning that, well, you want to take advantage of the tax benefit, right? You want to take advantage of the tax benefit, but probably you don't want to overdo it, right? You don't want to abuse it because, if you have too much debt to pay, you will lose confidence from all sides of your business operations and your investors. So this is what happens if you consider both tax benefits and the financial distress into the account of the leverage ratio, right? Into the account of how you balance debt and equity, right? So this is what you see here, right? So let's say we have the value of debt on the horizontal axis and the value of the unlevered firm on the vertical axis, right? So meaning that we want to see how our changes in the debt that we're going to issue will have the effect on our firm value, right? See how firm value changes along the debt issuance, right? So as we increases the debt, right, we see this, increasing trend, right, to the upper right, right? That when we slightly increase our value of debt, the value of the firm also increases, right? Value of firm also increases, right? See the green line and the purple line, right? There are two type of companies that reacts differently from leverage, right? So for the green company, right, it increases up till the point where it has the green D star high, right? D star high, right? It means that for the green company, the optimal leverage ratio, considering both tax benefits and the cost of financial distress, is somewhere around this D high, right? D high. Right? Let me write it out. Right? So this one, right? For the green company, this is where you want to fix your leverage ratio, or this is how much debt you want to issue, right? To take advantage of the highest amount of firm value, right? So your firm value reaches the maximum point over here when you issue the amount of debt, right? To here. Right? However, for the purple company, right? For the purple company, it is sort of different, right? So the purple company actually have a higher tolerance, right? Has a higher tolerance on the value of debt, right? So meaning that when the value of debt reaches this number, right, which is this number, the value of the purple company will reach its maximum, right? And any value above that will lead to a decrease in the firm value, because at that point of time, cost of financial distress is actually higher than the interest tax shield, right? So if this one is higher than this one, then there will be a negative benefits for increasing your amount of debt, right? Negative value for increasing amount of debt. Right? So this is what this graph is explaining, right? This is what this graph is explaining. If you do not consider financial distress, right? If you ignore this and just think about the value of the tax shield, then the value of the firm should follow this straight line, right? So this is V of U plus TC times D, right? So this is the tax benefit. And the more debt, right? More debt you're gonna issue, right? It means higher value, right? Higher value of your company is gonna be, right? If you do not consider financial distress. However, if you do consider financial distress, right? So if you do add financial distress into it, you will likely see that, there will be an increase, right? There will be an increase of interest tax shield, right, at the early stage of financing, right? And however, when the leverage ratio reaches a certain amount over here, right, your firm value will reach the maximum. And after that, interest tax shield will be smaller than financial distress. So in that case, increasing the issuance of your debt will actually hurt your firm value, right? So this is how we trade off, right? Basically, this is how we trade off these two type of frictions, right? The tax benefits and the cost of financial distress, right? Cost of financial distress. Okay, so this is the first two type of frictions, right? We added the tax benefits into our perfect world in the beginning, and then we added the cost of financial distress into our consideration next, right? So the third one is agency cost, right? The third one is agency cost, and agency costs actually can arise from the conflicts of many interested shareholders, right? Many interested shareholders. So let's hold this, right? Let's pause it here, right? And we'll talk about the next two frictions in the next video. Okay. So let's stop right here.